Welcome back, everybody. Today, I wanted to discuss something that I understand that there's a lot of people in different age demographics that watch these videos, younger people, middle-aged people, and then some older people too that are getting ready for retirement. And a lot of people come here for some financial guidance. Now, keep in mind that none of what I share with you in any of these videos is financial advice. I'm simply giving you the information that I have so that you can make the best decision for yourself and you can understand some of these key principles. So when it comes to investing, you do what's right for you and you're able to make an educated decision with all of this. And something that came to my mind that not too many people are in the know about is risk tolerance and what risk tolerance essentially is and how to address risk tolerance based on where you are right now, age demographic goals, and essentially what you're looking to accomplish. So first and foremost, risk tolerance and what it is. So if you ever call a financial advisor or a financial planner, this is one of the first questions that they're going to ask you is, what does your risk tolerance look like? What they're trying to understand is, are you okay potentially putting more money into risky investments with the potential of losing them? Risky investments being, hey, we don't really know if this thing's going to take off or not. It could just as equally go back as it could go forward. Are you okay putting your money into this, or would you rather put your money into something that's consistent that may not get you the rate of growth that a riskier investment would, but we know that you're at least going to play it safe and you'll be able to get a return on investment gradually. So it might take you a little bit longer to get the same ROI that it would on a risky investment, but at the same time, a risky investment, you might not gain anything. So that's what they mean by risk tolerance. And there's different levels and grades to it. So there's conservative, which is just basically playing it safe. There's also risky too. This is where you're like, hey, let's go all in on the risky stuff. I want a lot of upside potential and I don't really care how much I lose. So this is something that you want to understand because risk tolerance is huge, especially if you are somebody who may be getting closer to the age of retirement, because a lot of people that are getting closer to the age of retirement, they don't have a lot of time to make up for if they do end up losing money. So if they lose money, it's not like over time they'll be able to regain that back. They don't have that opportunity anymore. Where a young person, if they do lose money, then they have an opportunity over time to gain that money back. So what you want to understand first and foremost is like, what are you okay doing? And this is an internal question for you. Are you somebody who has enough expendable money to just say, hey, let's ride it all on the latest and greatest because I'm confident that this is going to pan out? Or are you somebody who's kind of like on the fence? You're like, I'm not really sure about investing. I just know that I want to make money over time. Because based on that answer, that's going to tell you if you should go more risky or if you should go more conservative. So that's the first thing, is you want to figure out what that goal looks like for you. The next factor is, again, how much time do you have to invest? Obviously, if you're somebody that's on the younger side, you can take more risks, because if you end up losing money, that's okay, because you'll be playing the market long enough to make up for those losses that you experienced in the beginning. So maybe taking riskier investments is okay for you. But on the same token, let's say that you're just like, hey, I'm building this for retirement and I'm okay starting at 18 because I want to retire at 50. So you want to play a more conservative game because you know you're going to get the 3 to 8% return on investment every single year until you hit that goal that you're looking to get at 50 years old. So a lot of times younger people are okay taking riskier investments unless, of course, your goals are set up differently. People, again, that are closer to the retirement age, they're not going to want to do as many risky investments as younger people do. I'm not saying that they don't. Obviously, there's a lot of good companies out there that you can put your money into that are risky but have a lot of upside potential, and you can get a pretty quick return on investment and then pull your money out. But if you're not somebody like that and you have a nest egg to protect, that conservative route might be the best route for you to go. where you know you're getting the 3 to 5% every year, you're happy with it, and you're okay not seeing those huge 20 to 30% return on investments. So this is really crucial for people to understand when they get into the investing game, is what that risk tolerance looks like. Because if you are wanting to play more risky, that's okay, but understand that you face a bigger chance of potentially losing money. Whereas if you're more conservative and wanting to keep that nest egg, it might be safer for you to just play an investment game where you're only getting 3 to 5, 10% return on investment every single year, because you know that, hey, again, I'm not going to see a lot of that upside potential, but I know that this nest egg is protected. So understanding your risk tolerance is huge for playing the investing game. And again, all of this is based on your goals. But if you are unfamiliar with the market and you're unfamiliar with where to start, I would say start by looking at your goals and what you want to accomplish. Your short-term goals as long as your long-term goals. And then also, how much money are you okay investing and potentially losing? Because all three of those questions are really going to help you determine if you should go more lenient and protect more of those assets that you're putting into the market, or if you're okay to go a little bit more risky. But again, go internal with these questions and you'll find your answer. So I hope that helped.